When we hear the term credit risk, most of us immediately think about loans. A bank lends money, the borrower fails to repay, and the bank loses money. Simple, right? But in reality, credit risk goes far beyond just lending. In fact, almost every financial transaction where payment happens now and value is received later creates some form of credit exposure. Let's walk through the major transactions that generate credit risk. First, we have lending. This is the most traditional and familiar source of credit risk. Whenever a lender gives funds to a borrower, there is always the possibility that the borrower may delay payments or completely default. If that happens, the lender loses not just the principal, but also interest and the time value of money. Think about a home loan or a corporate loan. If repayments stop, the bank directly bears the loss. Next come leases. In a lease arrangement, the lessor owns an asset and the lessee makes periodic payments to use it. If the lessee stops paying, the lessor faces credit risk. Even if the asset is repossessed, it may not recover its full value, and there are additional costs like maintenance, recovery, and remarketing. For example, a car leasing company may take back a vehicle, but selling a used car rarely covers all unpaid dues. Then we have receivables, or trade credit. This happens when goods or services are delivered today, but payment is expected later. Businesses do this all the time to attract customers. But if the buyer fails to pay or goes bankrupt, the seller suffers a direct loss equal to the invoice value. Imagine a supplier delivering inventory worth thousands, only to find the retailer unable to pay. Now consider prepayments. Here, the risk is reversed. Instead of receiving goods first, the buyer pays in advance. If the seller fails to deliver, maybe due to bankruptcy or operational problems, the buyer may lose the entire advance. Plus, they may face replacement costs and delays. Think about paying a contractor upfront and the project never starting. Deposits are another hidden source of credit risk. When customers deposit money in a bank, they are essentially lending money to the bank. If the bank becomes insolvent, depositors might not get their funds back immediately, or sometimes at all. While retail customers rarely evaluate this risk, large corporations carefully diversify across banks to protect their cash. Next are contingent claims. These are obligations that depend on some future event. Examples include insurance claims, guarantees, and pension promises. The risk arises if the counterparty cannot make the payment when the event occurs. For instance, if an insurance company fails to pay after a valid claim, the policyholder faces a direct loss. Finally, we have derivatives. These create indirect credit risk through financial contracts like swaps, forwards, options, and repos. Their value changes with market movements. If the contract is profitable for you and the counterparty defaults, you lose the replacement value of that contract. So even without lending money directly, you still face credit exposure. For example, in a currency swap, if the other party fails to honor payments, your gains disappear. So the key takeaway is simple. Credit risk is not limited to loans. It exists anywhere payments depend on someone else's future promise.